Price action profits, profitably trading the financial markets. Well, welcome to this program. And I am 100% certain you are going to benefit from it, or your trading is going to benefit from it. And you will make a lot more money by a deeper insight into how the markets function purely based on price action. I'm a price action trader. Name is George Nyabadza, and welcome to this show. What I thought we'd do today is just to use this first program to discuss, or for me to present to you, some of the terminology that you're going to be hearing me talking about quite, or using quite often in the future presentations. Only about 15 minutes maximum. Reminding myself to start the time. So it's nice and punchy, and you can get to it every week. And I will be sharing with you what I think is the best price action strategy for a given week, so you can learn from it. But for today, and I'll refer back to this as we go through the program, just go back to the first program and look at the terminology, or listen out to the terminology. So all I'm going to focus on today is the terminology. So I got UK Brent up. It really doesn't matter what market you're using. The terminology is the same for price action. One thing that should be pretty obvious for you is that I don't have a moving average on it, the exponential moving average. I used the 10 EMA, and I know some traders use 20, 50, 100, whatever. Doesn't matter, whatever you use, as long as you know how to use it and it works for you. So I've taken it out so that you can just look at the chart as it is, a naked chart, pure price action, and you can get insights into how I'll be talking about. When I present my charts and my trades next week going forward, you will have my 10 EMA on it, and we'll talk about that as we go along. So just a few things just to bear in mind. Here we have a trading range. Okay, that's the high of the trading range. That's the low of the trading range. So whenever there is a trading range and there's a breakout of the trading range, there is a breakout. As a price action trader, you got to be thinking, well, how far is this move likely to go? And the first thing we look out for is the measured move. The same distance, same height of the trading range. We always look out to see if whoever is breaking out, the bears in this case, are going to reach a measured move, and that is there. And they go to the measured move, bang, a little bit more price action. Now, for the measured move tool, I use the Fibonacci retracement. You can find it under Insert, Fibonacci retracement. And if you right-click on it, Fibo properties, my measured move, I've got the 0, 50, which is the midpoint of a move, 100, and then the 200 is the measured move. So 0 is the height of a particular move, 100 is the extreme of it, 50% is the midpoint of it, and I want to see the 200, which is the measured move. Everything else on it, you can just delete and just have those, 4 measures. There's 0, midpoint 50, 100, full range, and then 200 is the measured move. And you get to know how to use this. If I want to see the measured move for the bear price action, I'm going to where the price is breaking out, which is at the extreme low. And then I just pull my measured move back up to the height, and boom, there it is. If this is a bull breakout like we have here, there is a trading range, high of the trading range, there's a low of the trading range. Same tool that you use, except you go to the higher, where the bulls are breaking out, and you go to the low of the trading range, and you get to a measured move. So measured move tool is one that I use a lot. And you hear me talk of measured move. That's one tool to use. Another tool that gives us a variation of a measured move, that measures for us how far a breakout is likely to go after a pullback, is simply this tool that I call, well, it's a leg 1, first leg of the breakout, pullback, and leg 2. It's a leg 1, we have a pullback, we have a leg 2. So it's a leg 1, leg 2 extension. So if the bulls are strong after creating this breakout, we expect them after a pullback is done, at least to get to a measured move. Okay, same move, same height. That leg, market pulls back and extends. Now, for that particular tool, I use this tool, which again, you can find on Insert. There's Insert. You can find it on Insert. Insert, go to Fibonacci. That's where it will be, and you can find that. And now we're using the expansion, that one. When I click on it, it's exactly the same tool as I've inserted up here. So now let's do it on the bear side. So there is a bear leg. Bears are selling off. And we want to say, well, if the bears are strong, they want to get to a measured move after the pullback. And the measured move using the leg one equals leg two is simply there is leg one. There is a pullback where the pullback ends. That's where I want to put the end of the pullback, the beginning of the leg two. So there is leg one, pullback, leg two. So I have that on my charts, and I'm saying to myself, okay, a couple of things are happening here. We are breaking out of a trading range. I think the market, if bears are strong, get to the measured move. We also have a distinct leg one. There is leg one, the full breakout. From when we started, there is a pullback, leg one, pullback. The same distance of the leg one is expected to resume at the end of the pullback, and that's where we get to. And the properties, if you right click on your expansion properties, it is very simple. It's just one. 100%, that's the extension. That's how they've designed it. So that's an easier one to put in. Everything else, just delete. It's all we are interested in. So when you're this side of it, you kind of think, okay, the market is just broken out here. Oh, I don't know what to do. Should I not? And then you see this pullback trying to reverse, and then it resumes. So you say, based on the earliest first distinct pullback that I've got, I mean, that small tail is a pullback, but let's not worry about that. Best distinct pullback at that point could have been a big bull candle, and then it failed. I expect that we can get to here. If the market goes beyond a little bit, you can know that maybe the computers are looking at that as a pullback. They're ignoring the tail. But what we are interested in is always the earliest possible move, because that's where you want to decide, do I stay in the market? Do I get out of the market? So we've got two measures so far: trading range, measured move, a bear leg or a bull leg, wait for the pullback. And you want to see after you have the end of the pullback signal, how far the market's like to go. We have a pullback. We're using this tail that came to test that as the end of our pullback. Earliest, we know it's going to get to that. Now, another tool you can use, the same, now we've got a measured move off the rectangle with a leg one, leg two. You can do a measured move off just the breakout. This is where the market is breaking out. So let me see how far the market is likely to go just based on the breakout. So I'm using this tool now. I'm back to a Fibonacci retracement, the same tool that I have. So at the end of the breakout to where the breakout actually took place, there's another measured move here. So now you have a cluster of levels. What's important about this cluster of levels is that it is invisible to the eye unless it's a price action trader. You put it in, you're not going to see it, but it's there. Computers see it, traders see it to trade price action. So now we have a cluster of levels of support. In this level, potential leg one, leg two, just a breakout, all are clustered here. So if the market starts to do this and you're in a trade, you're not surprised because you know there is something happening there. Something else is taking place here that took place here as well. We have this 1, 2, 3, 3 pushes up. Anytime you have 3 attempts to get beyond the level, think of it as a wedge. It can be flat, it can be angled down or up. No, pressing the wrong things, jumping ahead, George. 3 attempts, 1, 2, 3. The market is trying to do something 3 times. 1, 2, 3. 1, 2, 3. Also here, 1, 2, 3. Whenever the market tries to do something times, it's a wedge. It's an indicator and alert that if it fails to get through that level, it might reverse quite dramatically and go in a different direction. So try it 1, 2, 3, sell off. tried to go down once here, failed, tried again, failed, failed for the third time. And then here we have 3 attempts. 1, 2, 3. 1, 2, 3. Eventually we accelerate up. Now, other things take place that give us more information. If you look at the little ABs that are put in red, those are double tops, double bottom. There's a double top here, 1, 2. Markets try to go up twice. It's a double top. It fails. End up with a wedge. Tries to go down twice. A, B fails. Tries to go up. Tries to go down here. Just one candle separating the two. You hear me talk about a micro double bottom. It's a double bottom, but separated just by one candle. 1, 2. And then we go up here. Bulls are breaking out above this level. Bears try to fail, bulls come back, micro double bottom, 1, 2, same place almost, and then we accelerate up. So you will get different variations of double bottoms and double tops. There is a perfect double top, perfect double bottom, perfect micro double bottom, perfect micro double bottom. Then here we have a lower low double bottom. It's a double bottom. Market didn't double bottom, same point, but it went down once, failed, went down again a third time, lower low double bottom. It is still the same forces. Market is trying to go down. A couple of times it fails. It might try the third time and then create a wedge. So you could actually say 1, 2, 3, micro double bottom, failed breakout beneath it, gives us another wedge. Then we have a bigger wedge. We talk of nested patterns, patterns within patterns. Parabolic wedge is a pretty sharp wedge. Micro double bottom, large wedge, another wedge within there. We get a high low double bottom. All are forces showing us that the bulls are likely to accelerate up. So after all of this and the market starts to go up, you have to find ways to go in because you've been given enough alerts by price action that the market is likely to go up. You have your measured moves here, 1, 2, 3. You have the market trying to go down 3 times. You have failure to break through a couple of times, a second, third time, and another third time. I say, so let's talk proper English here, George. Try it twice here, third time. So that's a wedge on its own. If you take this as 1, this micro double bottom, 1, 2, 3, higher low double bottom. We're starting to create higher low double bottoms, but we're still in a large wedge trading range. The market trying to decide which way to go. Bulls have 3 beautiful candles breaking about above that range. Bears try to fail and we go up again. Micro double top. Now we have 2 higher low double bottoms. Beautiful setup, as nice as they come. Gotta find 2 ways to go in. You don't know how far it's gonna go. Okay, that's a reminder for me to hurry up. You don't know how far it's gonna go, but you gotta find ways to get in. At this point, let's talk. We're talking about price action less. If you look here, market tried twice to get there, to break, failed. Bears tried to accelerate down, beautiful 3 candles. They failed. We had also within here, lower low double bottom. We had a wedge bottom also in there, 1, 2, 3. Double bottom, and then the market went up. Failed again at the same level, big acceleration down. Here, we break past this measured move we spoke about, the breakout candle, but we still have the high of today. And that's in the zone of leg 1, leg 2. So there's also a hidden level of resistance. It's there. We can see it. Good this time, fortunately, but there's also something else. There's a cluster of levels of hidden resistance that are within the market. They tried to get to there. They failed. We get a tight trading range. That tight trading range, again, you got to say, if the bulls break out above it, how far they're likely to go? Well, they want to get to a measured move off this trading range, which would take them above the high of today. They do that. Fantastic. Good for the bulls. Got to say, man, I got to find ways to get in. But then we don't get a decent setup. The bears try to make it fail, but they fail to get back below this tight trading range. We have the lower low double bottom, and we start to accelerate up again. Unless you trade in ranges, there's nothing for you to do. You got to wait for a distinct breakout to trade. If the bears are strong, they'll sell down. So if bulls are strong, they'll break out to the top, sell down, break out to the bottom. So at this point, you now have another wedge. You say, oh, now I understand what price action, what George is talking about. I have a wedge, 1, 2, 3. If the bears are strong off the wedge, they are going to accelerate down as they did here. I'll find ways to get in the market, and maybe we go all the way down here. Perfect insight, but you got to wait for more information. And guess what happens straight after this? Fantastic stuff. Immediately after that, you get a bull breakout. The bears failed to capitalize on the strength they had. Could have been a failed breakout above here. They could have accelerated down. So the bulls are pretty strong. Then we get this for the rest of the day. Absolutely beautiful price action. Why is it beautiful? This is where we were. We get a huge bull candle breaking out of here. And because the bears failed to break out beneath the wedge, now you get a bull candle. You've got to find ways to get in the market. Okay, you had bull strength here. Bears had the opportunity to sell. They did not capitalize at all. Now we have a beautiful breakout, just like we had a beautiful breakout here. You got to find ways to go in the market. And the question you ask yourself, how far is this likely to go? Just as we spoke about, if you just look at the breakout, so at a point in time, all you have is, okay, I'm measuring from the breakout here. Say, okay, if I measure from the breakout here, move it to the side, there is a breakout point. So if I decide to jump into here, the market is likely going to get this. You might think, should I get in or get not? Maybe I can, as long as I can manage my stop. But then they give us another bull candle and your breakout increases, right? So now you're seeing the profit targets getting a little bit further. So you can still take a trade somewhere in here. Excuse me, should drink some water. The breakout continues again. Now you have that, and you say to yourself, wow, the bulls can go quite a distance. Increases again. We're measuring the breakout bodies from the breakout point. And every time we look at the measured move, you can see the extent to which the bulls want to go. Eventually, the bulls get to that level, and then we get a pullback. So now you say, okay, I've taken a trade, I can manage it, and let's see if we'll get to that extent. If you haven't taken a trade and you've been waiting and say, oh, should I not? When you see the pullback and the bull starting to resume, now you can say, okay, I still have the measured move of the potential breakout where I think the bulls can get to if they are strong, and it's up here. But I can also put my leg 1 equals leg 2 extension. The leg 1, here you can start it at the, okay, stay there. There is a full leg 1 up to there. There is a pullback. Now, before all of this happens, you kind of sit in there, and that's what you're seeing, that we could get to that measured move, and the earliest one could get to there, so we might get there or in between there, or even just before that. So I'm going to take that trade and put my stop where I put my stop. If we break out above here, and the bulls only get to a measured move of this small trading range, that's as far as they'll go. But if they have strength, they're going to push to get to leg 1, leg 2, and the measured move. If they don't have, I'll manage my trades. And then this is what you get. They get to the measured move of this triangle, of this small rectangle, and then the market fails. So get out of your trade at break even. If you jumped in earlier, you've capitalized and made some profit. Later on, trading range, measured move, and you end up with a channel. All right, guys, so I'll continue to refer to this as probably the terminology video. And as we go through the days and the weeks that are going to follow, as we unpack price action strategies, I'll just go back to the terminology video and just get to grips with some of these things. Look for the wedges, look for the double bottoms, look for the double tops, look for the micro double bottoms, parabolic wedges, measured moves, leg 1, leg 2, leg 1, leg 2. These are basic things that every price action trader should have. All right, thank you very much. So name is George Nyabaza, and you'll be able to get this video, Price Action Profits, profitably trading the financial markets every Sunday evening. All right, guys, take care and enjoy the education with actions to wealth. It's the best place for any trader to be.